Good afternoon, everybody. Welcome to the FSRA 2024 auto panel discussion. Today we're going to be talking about auto insurance rating and underwriting supervision and the new guidance that will be released later this year. So I'm looking forward to a really lively discussion with everybody. Before we get into the panel conversation, just a few kind of housekeeping things. The session, of course, is being recorded, as were all of the other FSRA sessions. If you need simultaneous French translation, that is available, so put your hand up. And there are some instructions on the slide as well for those of you that are virtual that might want to receive French translation through the web portal. So please go ahead and do that. If you want to ask a question, please submit it online through the conference channel. You can also raise your hand and write down your question, and then it will pop up on the screen for me, and we can answer it during the Q&A session. So that's it. We'll get started. We're going to go through a panel discussion, of course, and then there will be some time for audience Q&A at the end as well. If we don't have time to get through all the questions, don't worry. We will answer every single question that comes to us. Some of them will be responded to via a Q&A after the panel discussion sometime later this week. So we'll get started. I want to take a few minutes just to introduce our panelists. I'll start with myself just very briefly. My name is Michelle Dodikin. I'm the new head of auto insurance supervision with FSRA. This is my 7th week, so it's still really new. But I am not new to the industry. I have 15 years experience in property and casualty insurance, and I've worked for some of the largest P&C companies in Canada. So bringing a lot of experience, very excited about the transformation that's happening at FSRA, and really excited to talk to you today about principles-based regulation and the new supervisory guidance. I'm going to start with Roosevelt. Roosevelt is a principal and consulting actuary with Pinnacle Actuarial Resources. He's an expert in predictive analytics applications for all insurance functions, rate making and product development, strategic reviews, competitive analysis, and litigation support. Roosevelt is recognized as an industry expert in the analysis of unfair discrimination and bias in rating, a really important topic for today. Roosevelt is on the leading edge of research on this issue and also provides services to clients in this area, including testing insurance company processes and providing training. Roosevelt is past president of the Casualty Actuarial Society, has served as vice president of marketing communications, and is the board chair of CAS. Roosevelt is also a board member on the International Association of Black Actuaries Foundation and is an emeritus trustee of the Actuarial Foundation. Turning to Michelle Huang. Michelle Huang is a seasoned leader in advanced analytics and corporate risk management. In her 18-year career in banking and insurance, she's taken various modeling and risk management roles from market risk to vice president of capital modeling, collateral analytics, and model validation to head of model risk management. She's currently senior director of model validation at Discover Financial Services, overseeing validation and risk management of AI and ML models used for consumer credit underwriting, portfolio risk management, marketing, fraud detection, and collection. Michelle has a PhD in mechanical and aerospace engineering and a Master's of Science in Statistics from Rutgers University. On my far left, we have Liz Belfleur-McCall. Liz is a senior actuarial analyst at Definity. Liz's primary responsibility is the development of predictive models and analytics solutions, both for traditional pricing use cases and non-pricing business needs. Since its inception, Liz has been an active and inaugural member of Definity's cross-functional working group for addressing the impact of social bias and fairness in predictive modeling and analytics. Liz is also vice chair of the Women's Empowerment Group and is a champion of inclusion, diversity, equity, and accessibility in the workplace. This year, she'll be stepping out of that role to advance Definity's work around disability and accessibility. As a community member herself, Liz envisions a workplace where disability is embraced as an integral part of diversity, such that employees of all abilities can bring their authentic selves to work and to thrive. So thank you for joining us today. I thought maybe, this is a panel discussion, but I thought maybe a good place to start would be to give an overview on FSRA's auto rate and underwriting strategy, and then a bit of a primer on principles-based regulation, and then a summary of our supervisory guidance. So starting with our overall strategy, there are 3 pillars to the strategy. The first, no surprises here, is fair rating and underwriting. So this is the basis for which how we evaluate whether rates are considered just and reasonable. And we'll be talking a lot about that because that's the basis of our supervisory guidance. The second one is about promoting market health and efficient regulation. So this is about more competition, more innovation, more choices for consumers. And the third pillar is informed decision making. So this is a topic, of course, that is not new to the industry, helping consumers better understand what they're covered for, how their premium is calculated, what their choices are in terms of pricing, and other aspects that they might want to consider in terms of the value proposition. So Joanne this morning did an excellent job actually of explaining principles-based regulation and how that's different from a rules-based regulatory model. Maybe we can delve a little bit deeper in terms of what that means for auto insurance. So in a rules-based model, of course, it's a much more prescriptive environment. We know what that's all about. It's the environment that we've been operating in, but the challenges associated with that are just more lag in the system. Change tends to happen slowly. There are a lot of constraints, and it really inhibits innovation. And some of the things that we're trying to promote with our new strategy. Generally speaking, for auto insurance companies, that also means that rates lag the trends as well. So you're always kind of behind in trying to catch up with rates because it takes a long time to move rates through, and there's an onerous regulatory process. So we've been making some of those changes within FSRA over the last couple of years, and the supervisory guidance is a really big step in terms of moving forward to principles-based regulation. And so it makes sense for us to spend a lot of time both in this session and I think in the coming months really understanding what that means in terms of how FSRA will work together with the industry in the future. So within the context of principles-based regulation, the focus is on outcomes. So not so much on rules, but on outcomes. But it doesn't mean that there are no rules. There are still rules, but the rules are aligned to the desired outcomes, and there's more flexibility around how they are applied, and the rules are in line with achieving those desired outcomes. So within that flexibility, we're hoping, again, that's going to stimulate more competition in the industry, new business models, new product ideas, and really start to reduce that regulatory lag that I was talking about before with rates and trends. So here's an example of, real-life example of principles-based regulation. The Autobahn is one example that comes up often, and so I thought maybe we could look at this and look at the difference between a rules-based regulatory model and a principles-based regulatory model. So in a rules-based model, we say, okay, the speed limit is 100 kilometers an hour. In a principles-based model, we say, okay, our principle is safe driving, and our desired outcomes are fewer accidents, injuries, and fatalities. And what's important about that also is that the outcome is measurable. And so we know what the principle is. We can all agree that it's really important, and the outcome is easy for us to measure in terms of whether or not it's been achieved. But even in this context where there are fewer prescriptive rules, there are still rules. There are guidelines on the Autobahn, so there's an advisory speed of 130 kilometers an hour. And then, of course, you need to use your judgment around road conditions. You know, if there's bad weather, if there's heavy traffic, you need to decide, you know, what's an appropriate speed, even though there isn't an enforceable speed limit in most parts of the Autobahn. There are also rules. Some of them are enforceable with fines as well, so the roads are monitored. Stay to the right, keep safe distance from other drivers, so no tailgating, no passing zones, things like that. So you can be pulled over and you can be fined for some of those things. And then there are circumstantial rules. So in scenarios where there's construction on the road, for example, there might be posted speed limits. And then again, those are enforceable. So we can see here how there is more flexibility in the principles-based model, but there are still rules that create structure. So it's almost like guardrails to ensure that everyone stays on track to reach the desired outcomes. So this is a bit of a sneak peek into our auto rating and underwriting supervisory guidance. This is still in draft, I think, which most of you know. So we're going to have some good discussions around this today, but keeping in mind that it's still very much in development. This will be released for consultation in the fall to the industry, so we'll be looking forward to your feedback, but that doesn't mean that we shouldn't have any discussions between now and then. This is a bit of an introduction, and it opens the conversation, and we'll keep talking about that as time goes on. So there are 4 chapters in the new supervisory guidance. The first one is fairness. It's not our only principle for rating and underwriting, but it is a really critical one, and we want to make sure that we get it right. We've dedicated a whole chapter to that. It's not surprisingly also really difficult for the industry to agree on a common definition of fairness. It's really challenging. You could look at this from a number of different angles. Our approach has been to focus, not surprisingly, on principles, and some of those principles are unfair bias, discrimination, proxy discrimination, rating accuracy, things like that, as being really core elements to fairness and, again, how we evaluate whether rates are just and reasonable. The second pillar is what we call operations, governance, and control. So this would be akin to what you would think about as your operational risk management processes within your organization. These will be very familiar to insurers. A statement of risk appetite with thresholds and limits, we all know about that. 3 lines of defense in risk management, clearly defined roles and accountability, so governance, strong data governance, and model risk management. So these are really, really key capabilities that exist within most mid-size to large-size organizations. It could be that there's some strengthening that's needed in some of these areas, and so as we build out the supervisory guidance, we'll provide more detail in terms of what our expectations are. But I think the key takeaway here is that most organizations already have these capabilities, so it's really just about tightening them and making sure that there's a really strong base to work from. The third chapter is our assessment guidance. So as many of you would know, and that we've shared previously, within the supervisory guidance, there will be an opportunity for companies to become accredited. And when a company becomes accredited, that gives them the opportunity to enjoy more streamlined filing requirements, just a faster speed to market, things like that. So Chapter 3 outlines the process for achieving accreditation, which is the assessment. So we'll be looking at fairness practices, certainly within your organization, and many companies are already working on that, as well as some of those ORM capabilities that are related to rating and underwriting. Not every company needs to pursue accreditation, and you get to choose the timing as well. So organizations will decide when they're ready to undergo an assessment with FSRA and decide whether or not they feel that that's right for them. I would expect that most medium to large size organizations will pursue accreditation when they feel that they're ready. It could be that small organizations choose not to. It could be organizations that file very infrequently. But our hope certainly is that most of the industry pursues accreditation and can start to enjoy some of the benefits of additional flexibility and innovation and things like that. The final chapter in the guidance is the new filing guidance. So the intention is to replace our existing standard filing guidance and our major filing guidance and consolidate that in Chapter 4. So the Chapter 4 filing guidance will include the filing requirements for organizations that are accredited and also non-accredited organizations. So as I mentioned before, many companies are already on this journey. We did some work in the fall, sent out some surveys to the industry to try and understand where they're at in terms of their ORM capabilities and where they're at in terms of their fairness journeys. And what we found was that more than 2/3 of organizations are already on this path. Numbers, in fact, even a little bit higher than that, but there are some gaps just through conversations that we're starting to uncover. So I would say those areas are things like model risk management, data governance, 3 lines of defense and ensuring that you have technical capabilities built into second line so that they can provide support to first line. So those are some of the areas that we'll dig into a little bit deeper, and our panelists will have a perspective on that that I think will be really important to share today. And again, as I mentioned before, insurers are in control of the timeline. Just in some of the conversations I've had with the industry since I've been at FSRA, there are some misconceptions about how the assessment process will work or whether it will be required. And so I just wanted to make sure that we got some of those messages out and made sure that that was clear. I'm not going to spend a lot of time on this slide, but certainly there's been a tremendous amount of work that has gotten us to this point. Research, consultations with various different stakeholders, and all of that feedback and all of that research has helped to inform the supervisory guidance that is currently being drafted now. So if you have any questions about that, we can happy to chat with you about it. So here's where we're going. Lots of actions to date for sure. The supervisory guidance is currently being drafted by our team. We're sharing that with the technical advisory committees, which on the technical advisory committees, we have representatives from across the industry that are already beginning to provide feedback. That guidance will be released to the industry in August, September of this year. It will be finalized in March of next year, and then will be in effect towards the end of 2025. If there are insurers out there that already know that they're interested in pursuing accreditation, we'd like to hear from you. We're looking for organizations that would like to be part of a pilot as we start rolling out the supervisory guidance. So at a separate time, reach out to us and let us know, and then we can start planning for that. Okay, so what we're talking about today, obviously really understanding the benefits of principles-based regulation as it relates to auto insurance, how to deeply embed some of those ORM practices into the organization. What we're finding is that these practices are really well known in the pricing and actuarial areas and in risk management, but sort of beyond that, there's less knowledge, less awareness. They're not necessarily built into decision making, so those are things that are going to be really important for the future. Mitigation of bias and discrimination in rating and underwriting models. Again, not a new topic, but a lot more focus and a lot more discussion about how to do this properly, how to make sure that those processes are embedded in your decision making, and how to evaluate your models and underwriting policies. And then the last point is just about working together as an industry to lead through the change. Mark and Joanne stressed this morning that within the context of a principles-based model, there is a lot of ongoing discussion between the regulator and the regulated industry. There's more data sharing, there's more conversation, there's a responsibility on the part of the regulator to understand the business context and the business strategy to be able to properly apply some of the principles that will be important to our decision making in the future. So I'll pause there and we will move to our panel discussion. I'm going to keep this slide up on the screen so you can address our panelists by name, which I think is important. Just one moment here. Okay, so my first question is going to be for Roosevelt. Roosevelt, can you talk to us about how principles-based regulation enhances consumer protection?
Sure. Thank you, Michelle. And I would apologize up front. I don't know what I'm dealing with, but my voice is kind of going in and out. So hopefully you can hear me okay. And I appreciate the opportunity to be here with you today. I actually got a chance to speak last year at the FSRA Exchange, and I must not have done too badly since you invited me back. So thank you for that. So I think a number of points highlighted in the slides that Michelle went through really sort of zero the focus in on consumer protection. But I think it's called out really specifically in one of the FSRA regulation guidelines, and it's simply stated a customer-centric principle. And the idea is that the customer is at the center of the outcomes that you're trying to achieve. And so if you look at a lot of the things that are described, improving consumer outcomes, encouraging innovation, encouraging benefits for customers, a lot of that will lead towards customer protection. And so fair treatment for customers, delivering value to customers, fostering informed decision making. In a rules-based environment, it's oftentimes the will of the lawmakers, the will of the regulators to try and establish rules that those who establish them, rightly so, believe that will lead to that appropriate consumer outcome. But oftentimes you don't leave in those rules the flexibility to be able to adjust when perhaps those rules don't exactly have the outcome that you so desire. And so the idea of the principles-based guideline is that you've got companies and you've got regulation working together to focus on that the true customer outcome. And when you're able to do that, that allows both, again, companies and regulators the flexibility to test whether those outcomes are happening. And if they're not, or if there are adjustments that need to be made, you can do that within the principles-based environment.
Roosevelt, is it really important for those outcomes to be measurable?
I think having measurable outcomes is important. I also think it's important to recognize that not everything is going to be measurable as well. There are things that we'll be able to test in terms of fairness, which I know Liz is going to talk about here in a bit. There are things like fairness that we will be able to test. There are things like customer impact that we will be able to test, especially in the context of things like rates. But there are also going to be some elements that may not necessarily lend themselves to a direct testable measure with the pass-fail kind of approach. But again, it's sort of like I'll know there's a problem when I see it. And so you've got to understand that the outcomes certainly should be measurable, and I think it does provide that level, or at least the known playing field. But you've also got to realize, and I think it was said earlier this morning, that there will at some point there will be some rules that are necessary. There will be some things that have to continue in terms of rules, just because you can't necessarily measure and tune to every single outcome.
I wonder if Michelle or Liz would have more that you'd like to add to that about measuring outcomes.
So first, I would like to thanks to Michelle for having me here and for the organizers of this wonderful event. So first, from my risk analytics experience, for sure, there are some things we can measure it. Actually, it's related, to be exactly, it's related to the risk management, identify, measure, mitigate, monitor, and report. So usually, for a company, you need to have some metrics and KRI, key risk indicators, and correspondingly, you will establish some thresholds based on your practice, based on your domain knowledge, experience. So put them together. Of course, it is measurable.
Roosevelt, can you comment on some of the challenges in this transformation from a rules-based model to a principles-based model?
Sure. Well, so first, I think one of the challenges is really just kind of managing the change associated with going from what has been a rules-based environment to a principles-based environment. And so it's really sort of reinforcing the mindset that there may be a tendency, especially as you go into it, that you still maybe want to make sure you're satisfying some of the old rules because you might believe that is still important. But it's important to really kind of sort of become kind of exercising the muscle that says, okay, we're changing here, and how do we continue to reinforce that change. It's also challenging to really, as you begin to focus on some of these other outcomes, like fairness as an example. As you go down the path of fairness, and consumers understand and insurers realize that fairness becomes an important focus for the principles-based regulation. One of the challenges might be the perception of why now the regulation and industry is focused on fairness. Was there a problem before that has always existed that I should now be upset or concerned about? Or the flip side is perhaps there's some that are potentially afraid of what might be found as you again go down this path. So I think it's important to continue to highlight the benefits of what this can do for consumers in terms of protection, in terms of improving consumer outcomes. And also the flexibility that it allows for companies to really improve the consumer experience, to really improve the outcomes that consumers may and potentially will see.
Roosevelt, we spent a lot of time talking about innovation and how principles-based regulation can encourage innovation. I don't know that necessarily within the industry there's a clear connection between the two, and I'm hoping you can discuss that a little bit.
Yeah, sure. And I you probably recognize this from my introduction, but I'll say it just to make sure everyone understands. I'm from south of the border, and so I will maybe sprinkle in some examples from my U.S. experience and sort of how that relates to the experience that I've had here in Ontario. But the idea of innovation within a principles-based environment, I think fits much more comfortably than it does in a rules-based environment. In a lot of cases, in a rules-based environment, the rules don't necessarily develop fast enough or develop in the way that they need to encourage innovation by companies. And so the challenge then that creates is companies have to attempt to innovate, but do so within a set of rules that maybe even don't still completely apply in today's environment. If we think about how fast the automobile has changed over the years, the automobile that I'm driving today is radically different than the automobile that I drove 15, 20 years ago. But in some cases, and I say this for certain in the U.S., the regulatory structures that govern auto insurance are still from 15, 20, sometimes even longer ago. And so because you don't have that environment that encourages innovation, a lot of times what you see is that innovation lags within the insurance industry. Over the last probably decade now, there were a lot of companies, insurtech companies, that came to the insurance space that were going to take over the insurance space because they were going to come in and innovate all of the existing companies out of business. Mm-hmm. And what they realized is that when they came to insurance, they had to deal with sometimes archaic, sometimes old rules that didn't allow for the kind of innovation that they desired to do. And so it ultimately tamped down, in some cases, just they went off and did something else somewhere else because they realized they couldn't do it in insurance. And so and we've got a couple of examples in the U.S., although one of those examples might go away if the legislators have their way. We've got one example in the U.S. of a state that really it's more of a principles-based environment than it is a rules-based environment. And a lot of insurance companies use that state as a testing ground. They'll innovate. They'll roll out new things there. They'll refine them, see how they work, and then they will modify or adjust them maybe to fit in some of the other states that they operate in. But I think the insurance industry, especially in the U.S., and the lack of innovation that's happened there is kind of a testament to sometimes just the way that rules-based environments don't work for innovation, and also just the way, in some cases, that companies have been conditioned that okay, it's not going to make sense to try to innovate because I won't be able to do it.
That's really interesting that PBR states are actually used as a testing ground for new ideas that can later be rolled out in rules-based environments where there are more constraints or where there's more lagginess, for sure. I'm going to move to Michelle now. And Michelle, maybe we can switch to OGC and ORM and dig a little bit deeper there. Mm-hmm. Can you talk to us a little bit about how insurers can leverage the new rate and underwriting guidance to be more resilient?
Sure, this is a very good question. So first, I think for most of you in the audience may wondering why Michelle from Discover Financial Services Company is here. Actually, my following response or maybe some insights from my end will just remove or maybe clarify your wondering. So what I wanted to say is I worked in most of my career, and for most of my career, I worked in financial industry, financial services companies. But for more than 2 years in my past, I worked for an insurance company, American Family Insurance Enterprise. So then I have two sides story, right? And now I would like to say it's cross industry, experience, knowledge can be learned from each other, and especially from financial industry, principle-based regulatory requirements are much there. For example, from my most recent experience working on model risk management, it's principle based. Like in US, we have SR 11-7. So this is supervisory guidance from FRB, from OCC, from FDIC, and from credit from government entities. So principle based, and for each financial company, they have their own understanding, interpretation of this guidance, and based on their firm's unique risk profile and their business models, they come up with their own solution. So this principle-based approach is definitely it's innovative and will help insurers with new technologies. Regarding this question, how insurers leverage this rule-based, principle-based risk management to help their business model, to help their risk management, I think first I would like to say it's to establish operational risk management framework. So what is a framework? Framework basically it's about governance, about your operational risk management policy, standards, procedures, all kinds of templates, job aids. So our firm has to have those things, policy procedures in place. And after that, it's you need to, like Michelle mentioned, you need to have different lines of defense. Majorly, it's 3 lines of defense model. So this is a framework establishment. After that, it's about implementation, about execution. You can't just have have things in paper, just have talk the talk, and then you need to walk the walk. So this is execution. And after that, the execution, how to measure it? And the question has been asked. It's about your risk identification measurements, your KRI establishments, your metrics, your thresholds. For example, if you put below 5%, it's green, and between 5% to 10% is yellow, and it's above 10%, it's red. So it's very obvious variable. And after that, it's risk mitigation. And work is conducted by human, human creates errors, mistakes. So everywhere there is risk, there is issue. So when we identify it, we need to have a work plan, we need to mitigate it, and eventually risk gets controlled. So this is also includes contingency planning. If the risk is huge, you should have some contingency plan in place. For example, system failure. If it happens, what should we do? So this kind of response need to be in place, and monitoring and report to your risk committee, to your board of directors. So the CEO, executives in the C-suites can be very aware of the firm's unique risk profile, and they can be very much responsive. And after that, I think this is not the last thing, but it's very important. The firm needs to be compliant with the law, with regulations. So this is a fundamental part to run our business, especially for a consumer-based business.
Michelle, in your consulting work, where do you typically see the biggest gaps?
Mentioning if we talk about gaps, because I have this consumer financial services experience and also insurance experience, and this is I don't want to just frustrate you, but I think this is not only my personal experience, but for most folks, if they have cross-industrial experience, they may have kind of impression. So financial firms, maybe it's more innovative. Talking about risk management might be more effective and efficient. So comparing two industries, I feel there are several gaps that I would like to mention. For example, lack of clear definition of stakeholder roles and responsibilities. This is so important, because once you set up very clear roles and responsibilities, people can just work on their job requirements, and then there is no just arguing and who should do this, who should do that. So everyone is clear. This is my upstream responsibilities. This is downstream responsibilities. So people are in place to take care of their own plates. This is very clear. This lack of definition of roles and responsibilities. After that, it's, for example, lack of effective risk management systems, like a GRC, governance, risk, and control. So if a firm has a very good, robust GRC system, actually all kinds of risks can be well managed. Not only operational risk management under it, it's model risk management. And at the same time, your, for example, liquidity risk management, your credit risk management, your like a PNC related risk management. At the top of the house level, if CEO would like to have a risk report, so just go to this system, click some buttons. So in the end, all kinds of risk profiles can be aggregated, and the reports can be correspondingly generated. And then it's lack of talents in the current era of AI, Gen AI, data scientists, and data engineers and modelers. And also the staff turnover is very, very quick, very frequent, and knowledge transferring, it's pretty much there. And related to this one, I also would like to mention another gap. It's model, not only model documentation, but also all kinds of business-related documentation. So it's not comprehensive, it's not transparent, and especially for some key business processes, it's not well documented. And then for people, new hires, it's very challenging for them to follow the key processes, key requirements to fulfill their job responsibilities.
Michelle, I wonder also if you can comment on some of the challenges that organizations face in really embedding the right mindset into their organizations. And as I mentioned before, not just in the pricing area, not just amongst risk management experts, but across the organization and embedded right into the business.
Thank you, Michelle, for another wonderful question. I think for this one, the first challenge I would like to say in the past, for example, in the era of rule-based regulatory requirements, I feel incentives for insurers were not strong. Sometimes it's very vague because cost was huge. The checklist is so long and it's a lot to do. And transferring from this rule-based requirements to principle-based requirements, as we just discussed, flexibility is much there, and especially the incentives to insurers are very obvious. For example, if you show your evidence, you have very robust risk management. ORM is so strong. Documentation is in place, it's very comprehensive, and for your business decision making, you have rationale, strong rationale, justification. And regulators come to exam and then provide green lights. And then, like incentives, you can see it's new filing guidance. This one will provide a very fast filing process for the accredited companies. And then for this company, their new products, new services going to market will be very fast. And then it's very competitive, and they can make lots of revenues and profits. So this one is the first challenge. The second one is, I feel it's most of companies a lack of strong risk culture. And most of them, it's very much reactive, like it's not proactive or even proactive and active. So in this way, when bad things happen and they just very much reactive, the solution is one time, not sustainable, not scalable. And to put them together, actually, the cost is huge for such a company. But they take this principle-based approach, eventually, their system will be very robust, and it's a very straightforward and a very comprehensive and very efficient. I think agile ecosystem react very fast. Solutions are very sustainable, so cost is much saved. Another one I would like to say is operational risk management actually is an integral part of enterprise risk management. So the third challenge is, I think it's like a firm's ERM is bottom up, not top down. So it's hard for bottom level individuals to push innovation. So if there is something from the top, advocates, for example, CEO says, let's do ORM, let's do MRM. So you can imagine the effect is huge. It's easy for people to follow. And the last one I would like to mention is the gap is it's very lagged adoption of modern risk management, the concept, the framework. Especially we talked about AI, generative AI a lot. So for companies, everyone needs to have a very adaptive mindset, open-minded to learn from outside and to be more like a modern technology oriented and react fast.
Thank you, Michelle. I'm sure there are many challenges associated with making this shift and really developing new processes and getting attention from across the organization, and not just where some of these practices have historically sort of been siloed within organizations.
Yeah.
Thank you so much. I think maybe we'll switch now to a discussion on unfair bias and discrimination. So I'm going to turn our attention to Liz, who's a bit of a change maker at Definity, and I'm hoping you could share a bit about your story there, Liz. We'll start with the first question. How can actuaries identify, measure, and mitigate unfair bias and discrimination in their models? It's a big question.
It is a big question.
Yeah.
Again, I just want to thank you for having me today and be a part of this really important discussion. I think that there's a huge responsibility for actuaries and data scientists to take this into consideration throughout the predictive modeling lifecycle. So when we talk about different bias considerations, I think for a lot of folks, the default is to just check at the model evaluation step. But realistically, bias can be introduced at any point in the predictive modeling lifecycle. So there's very important considerations that have to be made that might be specific to certain parts of your model risk management or your predictive modeling plan. So there might be considerations that you would need to make at the planning phase versus your data extraction or your preparation phase, and understanding, is my data inherently biased, and if the inputs are biased, what are my model results going to look like? So there's different detection tests that we can leverage depending on the type of model that we're building. So if we're thinking about it from an actuarial perspective, and maybe something that's more traditional in the pricing sense, so a lot of us are familiar with the development of loss cost models, which are typically one that has a continuous response variable. So for things that are of the similar nature, rather than a classification model, there would be certain techniques that we want to employ to detect bias. That being said, what works well for one type of model might not work well for another. So we really have to be conscientious of what that use case is and whether it makes sense for what we're building. But the same can be said about the mitigation techniques that we're using. So mitigation techniques also need to be specific in understanding what it is that our model's output is, and do these outputs result in unfair outcomes that we can control. But there's also times in which we need to be considerate of trade-offs. So it's possible that you build a model where you've detected bias, you can mitigate it, and the accuracy and the predictive power of your model is more or less the same, and that's very straightforward. But as Michelle was alluding to, there might be situations where that isn't the case, and you do have this sort of trade-off that you have to be considerate of, which is why it's important to build a model risk management framework that has this sort of ecosystem, right? So it's not just the responsibility of the actuary or the data science or the predictive analytics practitioner. Having this sort of cross-functional group to assess your models and properly vet the considerations and what outcomes look like for consumers is imperative. And without having that level of consideration and due diligence, it's very difficult to ensure that we truly do have fair outcomes for our consumers.
I wonder, Liz, if you can talk a little bit about the journey at Definity, just at a really high level, because you've really been such an integral part of them understanding fairness within their own organization and how to address it, not just in modeling, but in other areas of the organization as well. Can you tell us a bit about that?
For sure. So a little bit of background about our journey. We formally formed our working group to address bias and fairness in predictive models in 2022, but that doesn't mean we weren't actively doing it prior to that. The issue was that we were seeing these gaps across different departments. So some departments were very active and proactive about doing these sorts of checks, whereas some departments were more reactive in nature. And like Michelle was talking about earlier, being reactive is not sustainable, but it's also quite harmful. And so having this proactive approach is beneficial not just for a model risk management perspective, but also for the consumers at the end of the day. So recognizing that we had this gap was a true driving force for developing our working group, and to determine what it is that we wanted to achieve, because like we were saying earlier, it can be very overwhelming. You don't know where to start. There are many different considerations that need to be made, but we're actually lucky to be here today with one of the authors of some of the KES research paper series. And we used a lot of their work to determine what it is that we wanted to achieve and what made sense for our book of business. So we took a look at the literature and the research that was out there to determine, okay, what can we develop as practical tools that folks can leverage based off of the projects that they're working on, and not being overly prescriptive on very specific use cases. Now, that doesn't mean that we don't have this sort of lack of rules, if that makes sense, because you need to understand the why behind the how. And the why is something that we identified as a major barrier in our organization, because for a lot of folks who work as either actuaries or data scientists or anything else that's very analytical of nature, more likely than not, your undergraduate degree or your post-secondary education was within STEM. But historically, a lot of STEM degrees don't really address the effects of systemic bias on predictive models. And I don't know if they even do it today. They might, but I wish I had that when I was in university and I didn't. So knowing that even though actuaries go through this sort of very rigorous exam process, but this isn't actively addressed in our literature, it's a gap that needs to be addressed, because it's one thing to do the how, it's one thing to apply the tools, but if you're not fully understanding why you're doing it, or if you don't fully understand what you're doing, it makes it very difficult to ensure that what you're doing is promoting positive outcomes.
Mm-hmm. You don't even know what you're looking for.
That's it.
Yeah. Do you want to add anything on that, Roosevelt?
Well, there's a lot. I'll maybe pick up on one point that Liz made. I can't underscore enough that question of understanding the outcomes that you're seeing in fairness tests, and then identifying the appropriate way to address those outcomes. One of the challenges that we're wrestling with in the U.S. is that there's sort of two sides of the coin. There's some regulators that believe if I define this very specific test and I define a very specific parameter or a very specific outcome that determines pass or fail, then I've satisfied the fairness criteria. And one of the things that we've been saying to anybody that will listen is that testing is one thing. What you do with that test is critically important, because ultimately you could actually end up creating a worse situation on the outcome than if you did nothing at all. And unfortunately, especially in kind of the world today, the headlines drive more of the policy than sometimes the scientific reality. And so for those that are involved in this, I can't underscore that enough. There's one thing to test for fairness. What you do with the results of that test is vitally more important than even the test.
And maybe just to build on that, Michelle was talking about how we have different levels of sign-off, right? So a Definity part of that model risk management element is when we are building a new model that has a certain level of risk associated to it, not only are we showing that the model was properly built and whatnot, but we are also showing the proper bias detection and mitigation techniques that were applied. And when we are showing these things, it's not just to a VP who's also an actuary. There's this understanding that model explainability is not just from the perspective of data scientists, but to folks who might not be non-technical in their day-to-day jobs. So if we have folks who are in legal, for example, and we even saw this in our talks earlier today, they might not be analytics practitioners, but they understand the outcomes. And so when we talk about bias and fairness and the ways in which we are mitigating it, having a layered approach and not just a siloed one is crucial. And I think that if FSRA is moving forward with this sort of approach with PBR, it's going to force folks to get onto the same page.
I think that's such a great point. I wonder also, Liz, if the job is becoming more difficult with things like artificial intelligence and machine learning. It's just complex stuff.
It is.
Yeah.
Even with the rise of Gen AI, we have to sort of think outside the box as to how we can address bias with that, right? Because even if we think about large language models, there was an example that was being provided today in the previous talk about the app that was built that was essentially a chat bot about foot pain, right? And there was a clear bias in the way that the question was being built. And so naturally, the outcomes are going to be biased as well. And so it's it's complex, but I think it's something that we need to be actively thinking about. And by building PBR, it's going to be formulated in a way where we don't have to go, well, we've never seen this before, so we don't really know what to do. It gives us the framework and the tools to think, well, I've seen something similar before. How is this different? How can I leverage that and have this sort of transferable ability or toolkit to then assess something new that I've never seen before, but I understand it from other perspectives?
Okay. So this is more of an exploratory question, and I'll pose it to you, Liz, but I welcome anyone else on the panel that wants to jump in. How do you define what is fair, and do we need one definition of fair? Do we need to define it?
Yeah, that is a hard question. Thank you so much for asking it.
Yeah, everyone's wrestling with it.
Everyone.
So.
And I understand why. Even if we think about how we define fairness from a purely data science or machine learning or AI perspective, there is no one definition. And so this comes to be a problem for how we define it globally, right? So in the context of this, I think it's important that we can't take a sort of one-size-fits-all approach. It really has to be in relation to what we're talking about. So if we're talking about unfair outcomes with respect to, let's say, auto pricing, that might be different in terms of considerations that we would have for underwriting. And if with what FSRA is developing, I think what's important here is that they have the ability to be not overly prescriptive in terms of what's considered to be fair, because if we're asking the industry to define fairness on their own, you are going to have multiple different answers. And that makes it very difficult to ensure proper fair outcomes. But if we have this sort of guidance about what does fair mean in this context, then the insurers can go ahead and say, well, that makes sense given the business that I underwrite. And it allows the insurers to be on the same page, but it's also sort of a risk mitigation technique for the regulator themselves, because you're ensuring that everyone is on the same page, that they have the tools to assess what makes sense for their specific use cases, again, without being overly prescriptive. So I know it's not really an answer, because I don't fully have an answer, but I think that rather than having a one-size-fits-all approach, it's important just to formulate your considerations based off of what it is that you're working on.
Do you think organizations need to be declarative about what their fairness definition is? It's another tricky one.
That is a tricky one.
Very tricky.
I think it's something to consider moving forward with this.
Okay, it's a conversation
Absolutely.
starter,
Yeah.
certainly, for sure. Okay, the relationship between insurers and the regulator will change in the context of principles-based regulation. How do you see that? Well, how do you see it changing? What will work best? What support is needed for the industry? It's just a kind of an open-ended question, and maybe everyone can comment on that. Do you want to start, Roosevelt?
Sure.
Yeah.
So one of the refreshing things that I've seen as part of the principles-based regulatory structure is really just the collaborative environment that's been set up here. It's unlike anything I've ever seen in my career, and I think you're really on to something here. But I think that idea of the regulator and the industry collaborating to focus on the consumer outcomes it's the way really that regulation should work. To be honest, is that if everybody's kind of pushing in the same direction and focused on the consumer, then hopefully that change will continue. Certainly kind of reinforcing the principles-based guidelines. Again, with change, it's sometimes easy to revert back to what we know on both sides, industry and regulation. And so really kind of reinforcing the fact that this really is a changing environment and that we really want to do what's best for the consumer. I think will again require everyone to kind of flex their change muscles, but continuing to collaborate and seeing the benefits of that collaboration, I think will just continue to strengthen the environment going forward.
I agree. Michelle, would you like to comment?
Yeah, I feel this one will bring good things for both sides. And I just would like to echo what Roosevelt just said. So more collaborative, being regulators and insurers will be more collaborative and collective efforts. So it's not just one side. For example, usually in the past, regulation was the governance body there, and the insurers have to follow all kinds of rules, checklist. But going forward, because it is principle-based, and then there will be lots of conversations. So there will be lots of mutual understanding consensus for this specific business requirements situation. And in the end, following the principle and the solutions will be much better, and also it's agile based agile solutions, and it's and at the same time, I mean, solutions would be very sustainable and scalable, not just meet the specific rules, but the principles is kind of at the high level. So I would like to use the two words, sustainable and scalable, to describe that.
I really liked what you said about it being a collective thing, because fairness is a collective issue. Like even if we strip away this sort of pathway to an accelerated filing process, if some insurers are doing it really well but others aren't, you haven't mitigated bias. It's still going to be there. If you have these pockets of industry where some insurers are doing it really well and others aren't really addressing it at all, then you are still looking at unfair outcomes. The disparities will still be present. That's why I think that it's important that FSRA is taking that on and integrating it intentionally and not being reactive, because if everyone is on that sort of same page and understanding of fairness, that will ensure fair outcomes for our consumers. And ultimately, at the end of the day, we're in the business of consumer protection. Consumer protection is a collective that is not something that one insurer does and the others just follow in whatever way they say makes sense. It's something that we all need to be buying into, and I'm hoping that with the supervisory framework moving forward, that insurers will understand and put in the work and the time to understand why this is important, why this is valuable, and why this can't just be the responsibility of one specific team in an organization.
I love that, and I love this idea of the principles almost like being shared values between the regulator and the industry, and we're all working together in order to achieve the same outcomes, for sure. And more dialogue, so we talked about that this morning, and I mentioned it earlier in the talk, that there just really needs to be more exchange between FSRA and the industry in order to make PBR a success going forward. So we're looking forward to that. This is one of many discussions that we'll be having with the industry, and you'll see us out meeting with insurers and responding to questions and providing all the support that's needed to make sure that this is a really successful transformation and that everyone wins. Consumers win because we achieve all the outcomes that we were talking about before, and insurers are able to innovate and bring products to market more quickly, move rate changes through more quickly, and all of that, all the flexibility that's needed for a healthy marketplace. So that concludes our formal panel discussion. We are now going to take questions online and in the room. And if there are any questions that are left unanswered, as I mentioned before, we'll catch up with those separately. Okay, the first question, which is anonymous, was when FSRA has its supervisory framework and new guidance live, what happens to UDAP and TAC? So I think everyone is familiar with UDAP, but for anyone online, unfair, deceptive acts or practices, and TAC is the take all comers rule. So the short answer to this question is nothing. Nothing changes with either a UDAP or TAC. TAC is part of the Insurance Act, and UDAP is a rule. So effectively, they're both legislation. The supervisory framework is guidance that will be issued. So Joanne mentioned this morning that we're moving to kind of a hybrid model where there's principles, but there are also rules, and so those are rules that will remain in place and we'll continue to supervise against them. The next question is, will FSRA define fairness for insurers? How will FSRA evaluate fairness? So fairness is Chapter 1 in the supervisory guidance. As I mentioned, we're working through some of the principles of fairness, so unfair bias, discrimination, proxy discrimination, rating accuracy, things like that. So we're working through all of those pieces right now. Whether there will be one common definition of fairness, I would say there will be common principles that we'll all be measuring ourselves against, and we'll have to think about what some of the outcomes are that we will test within the context of the new guidance. The next question is, besides fairness and transparency, what are the other principles for auto insurance? So FSRA has 6 key principles that are listed in our standard filing and guidance. Certainly, fairness is one of them as part of our consumer focus principle, but there are also things like sustainability, innovation, transparency, and other measures that will be part of Chapter 4 in the new guidance, the new filing guidance. So the standard filing guidance will go away. All of the principles are articulated there. They'll become part of the new supervisory guidance. The next question is for insurers that are accredited. I guess the accreditation status will be good for several years. Can you please clarify? You mentioned proactive supervision. Does it mean that FSRA will continuously monitor and audit insurers? This is a great question. The time frame that we're working with right now for accreditation is 3 years. So you go through the assessment process, you become accredited, and then officially or formally you won't be reassessed for 3 years. But during that time, there'll still be ongoing monitoring, what we call proactive supervision. So there'll be regular data exchange, regular interactions with insurers, and testing of some of the principles to make sure that they're being applied consistently and that we're achieving the right outcomes. So there will be ongoing monitoring and supervision even after accreditation takes place, and then of course another formal process in 3 years. The next question is, my organization has operational risk management in place. Does FSRA expect insurers to create a new one for Ontario auto insurance? Will FSRA's new ORM framework benefit consumers? So I'll answer the first question. No, organizations are not expected to create a new ORM for auto insurance. A lot of those practices are already in place within most organizations, as I mentioned before. I would say in small organizations that would be maybe a difference just due to resources and the size of business, and having that sort of infrastructure within their organization isn't necessarily warranted. So we'll be applying, the principles of proportionality when we're doing the accreditation if those organizations pursue accreditation. But we're not expecting companies to create anything new. But we will have minimum requirements in each one of those areas, and it's important that their ORM is robust and that it is consistently followed, and so there'll be testing for processes and that sort of thing. So hopefully that answers that question. The next question, does it mean that accredited insurers will get the approval for new products and business models much easier and faster? Will accredited insurers need to file at all? So accredited insurers will need to file. The requirements for filing will be different for accredited companies than it will be for non-accredited companies. But the idea here is that we'll increase speed to market. So accredited insurers, having demonstrated that they're already operating in line with our principles and they're serving target consumer outcomes, will have a streamlined process for applying for rate changes, product changes, new model changes, things like that. But one of the things that I really want to impress is that it is possible to test new products and new business ideas today. We have the Innovation Office. We wish that the Innovation Office was busier than it is, but we do have the ability, even today, to review those new business ideas, and we're very much eager to hear about those ideas and provide opportunities for organizations to test new business model ideas, new product ideas, things like that. So I guess from this question, what I'd like to impress on everybody is that we're open for business from that perspective, and we'd really like to hear more of those proposals coming forward. The next question is FSRA's accreditation system created for large insurers only? Small insurers do not have resources. How will small insurers be evaluated in the accreditation system? So as I mentioned before, our expectations for small organizations with small books of business and that have less risky profiles will be different than the accreditation requirements for larger, more complex organizations. The details of that will be articulated in the supervisory framework, but the short story is that there will be advantages even for small organizations to achieve accreditation, and will be reasonable in terms of how we approach those requirements and what our expectations will be. The next question is, what are the timelines for accreditation to start? When will companies be able to start applying? So the new supervisory framework will be in effect towards the end of 2025. We're hoping that some insurers will come forward earlier in the process and express interest in being part of our pilot. But it's not too soon for us to start hearing from organizations and start lining that up, but the assessment process won't start until towards the end of next year. The next question is, why is PBR good for consumers and good for insurers? So I think we covered this question at length. But just to summarize, for consumers, certainly fairness in rating, more choice through innovation, rating accuracy. I think all of those things are wins for consumers, more value for money through innovation and new products coming to market, things like that. For organizations, I think it's more flexibility. So with being focused on outcomes, then it gives insurers the flexibility to solve for that, have more flexibility as long as they're achieving the target outcome. So they can decide how they achieve them, and there's more flexibility around that. A question maybe for Liz and Michelle, for those of us who are not underwriters or developing models, can you give an example of how bias may come up?
Do you want to start?
All right, I can start. So this, thanks for this question. For any business, actually, there are models, right? Model outputs are used in our strategy, in our business decision. And sometimes, for another set of strategies, use cases, actually, there is no model involvement, but there are some like rule-based decision-making processes. And just because of, for example, it's rule-based, is factor-based, so the rule and the factor may contain some, like bias related, for example, PII related information, and in the end, the business solutions, decisions may contain bias something. So this is one example I can provide. So Liz, you can, more.
You said exactly what I was going to say, so thanks. But I will expand a bit on that because I think that for some folks, or at least what we've seen internally, is that this is the responsibility of the actuaries, the data scientists, the analytical folks. Bias can be as simple as a rule, right? It could be something that's exclusionary. It could be something that is unfair, that isn't the result of a model output. But I don't think enough folks realize that a lot of business decisions are from model outputs. They're just not directly building them. They're using what was the outcome of that model. So I think it's important to not just understand that, but to challenge your own internal biases. Everyone has bias, and that's not a social commentary on whether you are a good or a bad person. Everyone has bias. That is normal. but understand how that relates to your work that you do, how that relates to the consumers that you're serving, and reflect upon that actively, because when it comes to the notions of bias and fairness, it's not a checkbox, it's a journey at the end of the day.
Thank you so much, Liz. Okay, I think we're at time. So thank you everyone for joining us today. And I want to say thank you to Roosevelt, Michelle, and Liz for joining us. And we look forward to more conversations with you in the future. Thank you. Thank you.